Okay, well, let's go ahead and start us off then. Thanks everyone for joining us today. My name is Mark Finley, and for those of you who don't know me, I'm the fellow in energy and global oil here at the Baker Institute at Rice University. We've got a great discussion lined up today. You know, as we put this webinar together a month ago, we thought the Game of Thrones reference, "Winter is Coming," was a clever introduction. It seemed like a good idea a month ago. It turns out that literally every energy analyst on the planet has had the same thought. And so I will apologize in advance for the less than original title, but I think we have a lot of original and useful content lined up for you all today. And frankly, the Game of Thrones "Winter is Coming" reference makes sense. We've just entered the fourth quarter with the world's biggest energy exporter fighting a war in Europe. Both Russia and many of its main customers are trying to use energy for leverage. And that, by the way, is a story that spans the fossil energy spectrum. For oil, both crude oil and refined products, for natural gas, and even for coal. The Russian invasion has focused market attention on risks to supply. Now, despite early fears, oil supplies have not been significantly disrupted so far. But decisions are looming. The EU is scheduled to implement an embargo on purchases of Russian crude oil in December and an embargo on purchases of refined products in February. The G7 countries, including the U.S. and the main European players, have agreed in principle to try to implement a price cap on Russian supplies. And there is the risk that Russia will unilaterally cut supplies. Putin has already said, for example, that he would refuse to sell crude oil into a price cap arrangement. Unlike oil, natural gas flows to Europe have already been significantly disrupted, impacting prices in Europe and globally via liquefied natural gas prices. And like oil, the prospect or risk of further disruptions also looms. And of course, all of this is taking place in a broader market context. Literally, as we are starting, the OPEC Plus group announced its intention to implement a 2 million barrel a day cut in production with effect from November. That's a group that includes Russia as well as the world's biggest oil exporter, Saudi Arabia. We're looking very closely at what's happening with inventories for oil and natural gas around the world, including for oil, releases ongoing in the United States and elsewhere of strategic stocks. Recession risks are looming with significant implications potentially for the demand profile. In the oil sector, we're also worried about refinery maintenance and general tightness in the global refining system. For those of us in the Gulf Coast, hurricanes, we are still in the hurricane season, and our thoughts go out to Ian's victims. Any of these would be important in their own right, even without the Russian invasion. But with it, the cumulative effect of these factors is amplified. Now, those of you who've joined our webinars in the past, remember that these are quarterly oil market webinars. We've added natural gas for today's discussion because it's been in the news and it's important. European purchasers and Asian LNG buyers are paying the equivalent of $300 to $400 a barrel for natural gas right now. And all of this matters. It's been made very clear to us, as if we needed the reminder. We need energy that's affordable, sustainable, and secure. And even with the focus on energy transition, as the 27th UN Climate Conference, or the COP, kicks off in a few weeks, for now, fossil fuels are still over 80% of the world's energy mix. And we see how higher prices have impacted consumer pocketbooks and consumer confidence, as well as industrial activity and jobs and elections. And in turn, it is explicitly part of Russia's strategy to outlast its opponents. We have a great panel to discuss all of these issues and more. Their bios are available on our website, but Anne-Louise Hittel will share Wood Mackenzie's oil outlook. My colleague at the Baker Institute, Anna Mikulska, will discuss the geopolitics and market outlook for natural gas. And Jason Elliott we'll review the International Energy Agency's emergency response capabilities, especially for oil. Each of our panelists will begin with a short presentation, and then after a brief discussion with the panel, we're going to turn to your questions, which you can enter using the Q&A button on the bottom of your screen. We'll be monitoring those in real time, and we'll get to as many of them as we can in the time that we have without taking advantage of your time or that of our panelists. So with that, Anne-Louise, over to you.
Hello, everyone. Can you see my screen okay, Mark? All right.
Yes, we can, Anne-Louise.
Great. Welcome, everyone. It's great to be here. So I'm going to take on the challenge of trying to figure out the oil market in the short term, even as Mark indicated, OPEC Plus is gathering in Vienna. So let's just focus on the fundamentals. And this chart, where are we today? What we're looking at on the chart to the left is year-on-year growth in supply. This is all in. It's OPEC, non-OPEC, NGLs, processing gains, refinery processing gains, the whole works. And what's interesting about this year is that we've got 4.6 million barrels a day of supply growth. And actually that was needed because last year supply only rose just over a million barrels a day, yet demand growth was far higher. So this has helped rebuild inventories this year. And that's one of the reasons why prices sold off towards as we moved out of the summer and towards the autumn, because of the fact that inventories were just starting to refill and fears of recession were hitting. Now, next year, the supply growth is is less, 2.2 million barrels a day, but it's at risk of being more than demand, demand growth, depending on how big and how extensive a recession could be. If we look at the slide on the right, we can see that demand is holding up, but what's interesting is that downturn, in early next year, and that's reflecting the effect of the EU oil import ban on Russia's crude production. That's largely what we're showing there. So we've been getting a steady increase. Russia's production has held up pretty well, but we think that in the first quarter it could take a hit as crude that it used to go into Europe needs to move on to further markets, and not all of that will get picked up right away in the first quarter until those logistics get worked out. Overall, though, we're looking at moderate supply growth, and it is not all coming from OPEC. This 2.2 includes sort of quiet supply growth that we don't really think about that often, such as Guyana, which is showing strong growth into the end of this year. Small producer, but at least throwing in 100 KBD into this market in terms of growth. The U.S. is finally going to see some growth next year. This year, 500 KBD of growth year on year for the lower 48. Next year, we're showing 600,000 barrels a day year on year for the U.S. lower 48. So there is non-OPEC growth next year, as well as relying on potentially, to a degree, OPEC. So let's turn next to some of the components of this supply picture. This chart is showing, this is really the nub of the issue for the market and OPEC and its decisions, because what we're showing here, this is just OPEC, it's not OPEC plus, but the gray dots represent the target that OPEC has currently. And then the actual production is the blue bars. And what you can see is that OPEC's production is running just over 1 million barrels a day, less than its target. It's about 1.4 million barrels a day below its target. If we look at Russia, it's running 1.3 million barrels a day, its target. What does this mean? It means that if OPEC Plus agrees in Vienna to cut 2 million, let's say 1.8 million barrels a day, is which the latest discussion is talking about. If they agree to cut 1.8, the question becomes, will it be from this target or will it be production? And we think is not going to be 1.8 million that actually comes out of the market, because the target is well above where they're producing. However, we do think there will be some cuts. It'll be less extreme than the 1.8, but yes, there will be reductions. It's just that it's not going to be the full 1.8 for OPEC plus, both because Russia's already below its target and so is OPEC. So that's one component of supply growth next year currently and next year, or supply next year. Now, if we look at this chart, Mark already mentioned what's really been interesting is that Russia's production is held up despite the fact that it's engaged in a war. And what this chart is showing is is showing is crude oil exports. Let's see if I can get rid of this. There we go. It's showing Russia's crude oil exports, not its product exports. And you can see here this big shift that's occurred since the war started. The red bars, and this is the chart on the right, the red bars show the pickup from India taking Russia's crude exports. So it's cut way back from other producers, such as Northwest Europe, much smaller share, but India has taken up a much larger share. And as well, you can see that Asia, which is mostly China, has continued to take crude from Russia. The Med has increased, and that's a large part of that is Turkey as well as, and this is where it's going to be interesting, a chunk of that is to Italian refineries that are owned or operated by Russia companies. So that's where we're going to see some of these hits when the EU crude oil import ban goes into effect. Let's look at Russia's actual production as in the fourth quarter and into the third. So what we're looking at here is, okay, this is before the war. This is crude and condensate. And then the war kicks in. Russia's production does fall off as the sanctions take effect. Refining runs fell within Russia. Domestic demand weakened. And as well, sanctions did for a while stymie exports. All of that meant that production fell. It did recover to a degree. It fell again over the last few months. And then, as I mentioned, we think there's going to be another turn down in the first quarter, while some of the exports typically destined for Europe fail to clear and to distant markets or even new markets. But we think eventually this will get sorted out and we will see a stabilization, at least, in Russia's production. But obviously, this is a very much a moving target and at risk. So it's something to think about as we move into this winter. Here's another one that's at risk as we think about just general production right now in this unsteady environment. Now, before the war started, Kazakhstan's production was running along just below and around 1.9 to 2 million barrels a day. However, it fell sharply, but this was not due to the war. It was storm damage to the loading buoys of the pipeline that moves Kazakhstan's crude into the out through eventually into the Med. Now, what's really interesting for us to think about is this second bullet point, because in July, a Russia court ruling threatened to shut down that CPC pipeline, which routinely ships about 65% of Kazakhstan's crude exports. It turned out that the ruling was successfully appealed. However, let's keep that in mind as a risk to supply as we move into the winter. Let's turn to the demand side of the equation. Okay, so we've been showing strong supply growth this year. And this is where we can see here in this chart to the right why we have seen inventories build. Because this year demand growth has only been 2.3 million barrels a day versus that 4.6 million barrels a day that I showed for supply growth on my initial slide. So you can see that growth has been far larger than demand growth. And that's helped create a rebalancing in the market. It's one of the reasons why we were not in the camp looking for prices to go up to $250, $150 a barrel this fall, because we actually saw supply growth surpassing demand. But next year, this demand growth that we're projecting here of 2.5 million barrels a day, that is at risk. If a significant recession develops in the U.S., EU, and China. Now, we've done a good deal of downside risk here, but there's more, and it could end up significantly less. And that's probably what makes oil a little different from gas, in that if the recession hits, we are going to be in a market of ample supply, even if OPEC cuts its production, which is one of the reasons why OPEC Plus is discussing a cut, is they're well aware of this recession risk. One other point I want to make on demand is that keep in mind, one of the reasons why we're still getting demand growth on this scale is because we're not back to 2019 levels. Refined products here on the chart to the left, you can see that jet is still well below 2019 levels. This is a comparison of the change against 2019. The only product this year that's going to nudge above 2019 levels is fuel oil. And that, of course, is because of switching from gas to oil in such places as Pakistan, Bangladesh, on the margin in Europe. Not significant amounts, but enough to help push fuel oil above 2019 levels. But look at how gasoline, jet, and diesel are still below 2019 levels, even into next year. And this is one of the reasons why even there's going to be some growth, even in a recessionary environment, because people are just getting back to normal. And it's starting to pick up, just getting back to normal. That's helped drive some of this demand growth. Now, in my closing comments, I thought what we could do is look at what does all this mean for prices? Well, it's a very uncertain environment. However, we're looking for a bit of a price recovery from where we are today. This was driven mainly because of that risk to supply from the EU oil import ban that kicks in first for crude in December and then for products in January. And that we think is going to help lift prices, a bit of a recovery on prices. And that now we know could also be helped by the addition of an OPEC plus production cut. Of course, the cut itself will come from OPEC, since the biggest OPEC plus non-OPEC member is Russia, and it's running over 1 million barrels a day below its target. Now, prices could very well weaken next year. This is assuming no supply shock, and that's just because of continued supply builds that we're looking at, which will help oversupply, I should say, or stock builds, which will help keep prices in this more moderate range. We've included here what could happen to prices if a recession were to significantly kick in and weaken that demand growth that I was showing you in the chart just before. And so I'm going to conclude my comments by taking a look at what we're showing here for these risks in this market. There are a lot, but I've zeroed in on 3 upside risk and 4 downside. And I won't take too long to convey this, but let's just keep this in mind as we think about the winter ahead. First, Russia could limit its exports, as Mark mentioned. It has the choice to do that, particularly with the G7 talking about trying to impose a price cap, which we don't think will be highly effective in this market, given those consuming nations that are still taking Russian crude. However, if Russia were to limit its exports on the back of these kind of threats from Europe, that would put us into a tighter market for sure. As I mentioned, we still think this EU crude import ban is going to have some play in the market here late in the year. It could have a little bit more upside effect than what I've conveyed in our price outlook. And then finally, we could get a cut in production from OPEC that's larger than we expect, or even from some of the OPEC members such as Libya. And these are not planned cuts, but some of the instability in countries like Nigeria, Libya, or potentially even Venezuela, although it's already very low. Now, downside risk to price. Well, there's still a nuclear deal talks being talked about, but I wouldn't count on that. It's not in our outlook, the pickup of Iranian crude. Slower economic growth, we've talked about that. Here's a biggie, COVID lockdowns. Now, our view is for China's demand to actually decline this year on year, which is amazing from such a major consuming country. But we do think it will recover next year, partly on petchem. However, if we were to see these COVID lockdowns lock in significantly next year, that would have an effect. And then unexpectedly, if this price cap were to actually be accepted by all potential buyers of Russia oil, that could be somewhat of a downside risk to price. And at this point, I'm going to hand the call back to you, Mark.
Thank you very much, Anne-Louise. Why don't I turn next to Anna?
Okay, I'm going to go ahead and share my screen. Okay, just a second.
While you were calling your screen up, Anna, I just wanted to remind people to feed in questions as they occur to you in the Q&A bar. There's already a few, and we will look forward to getting them.
Yeah, I'm going to just get, I don't know why now it does not want to share it while we were able to do it before. Now I see it. Okay, we all good now. Okay, perfect. Thank you so much for having me. I'm really excited about talking about what I've been looking at for for years, but it's what's become really a big hot issue in the most recent past and ongoing natural gas, particularly natural gas in Europe and Russia's impact on that. So a big story here will be temperatures, really, and that's kind of one thing that I want to underline. That's the one big uncertainty that we're going to be facing. And it's not only temperatures in Europe for European supply, but also temperatures in Asia and temperatures in the U.S. and how much these countries how much gas can be shared around between those countries, in particular Europe and Asia. So as I've mentioned, I've been looking at the issues of gas, geoeconomics, geopolitics, and Russia for a while now, but particularly since the beginning of the invasion, my colleagues and I have looked at those issues even more specifically, and there is quite a lot of literature that we have contributed to in this regard. So if you'd like, please go ahead to our website. You will find it all there. And a lot of the slides that I'm using here actually I used from the Baker Institute research presentations that we published on September 2022. So as I've mentioned, a lot of eyes in terms of natural gas market are looking at Europe and what happened in Europe. The high prices globally are also sparked by the European unexpected demand for LNG. And that's kind of I see it as a root of a problem, but there are other aspects, and Mark has mentioned them before. Other issues, even throughout this last summer, the issue of high temperatures, low rain in Europe, the inability to support enough hydro, high prices of coal, or inability to actually ship coal to generation because of low levels of water in the rivers. So lots of aspects that actually contributed to what's happening on the market. But truly the biggest one is the fact that Europe has lost most of its major supply from that's the supply from Russia. And here I wanted to kind of show those pictures of how much really Russia has been worth in the European market. And that's quite a lot. And 2019 is probably the best one to look at, because that's when we kind of had relatively typical market. And then, we moved to 2020, lower needs of the market, obviously, and still Russia holding quite a lot, because over 43% of the market. 2021, we see already a decrease. And that's kind of where really we have started to see the issue occurring. It hasn't been the invasion that sparked cuts in natural gas market supply from Russia to Europe. We've seen the cut during COVID that was actually driven by European buyers refusing to bring in more Russian gas. Instead, a lot of it was actually European buyers were buying a very cheap LNG cargoes that were there and available and filling up their storage. So they went into the winter of 2020 quite well supplied, but that's when things really started to fall apart, with Russia decreasing its supply to Europe at the time when we've seen the recovery from COVID picking up and the increased needs for natural gas. And at that time, Russia, they kind of justified it by, were saying that they basically supply whatever they contracted for, but they were not willing to supply the spot cargoes that at that moment the European economy would definitely bring in. In addition, some or a lot of the storage that Russian companies owned in Europe were not supplied enough. So the big story of the end of 2021, or the summer or fall 2021, was that the storage in the EU was nowhere close to where it's supposed to be. Of course, all bets were off once the invasion of Russia on Ukraine kind of happened, and we see really falling off of the supply at that moment. to the point where it's pretty much at a no now, with the exception of the Turkish stream. So that's where we still see Russian supply coming in. That's the new pipeline that was introduced in 2020 from Russia through Turkey that reaches actually southern Europe. So that's the little corridor that's still there. But we see a falling off of Russian supply. So when you see to the right side of the slide, that's that, and at the same time, pickup in supply from Norway, and of course LNG is out there in terms of how high of levels we've been seeing now Europe importing. Well, obviously, when there is a shortage or there is a very tight market, we see prices go really, really high up. And that's exactly what we've seen. And that's exactly what Russia has been counting on. In fact, a lot of the things that Russia has done throughout the, since the 2021 until now, really, is to not only to take away supply, but also to disrupt the markets, to create chaos that creates uncertainty, of course, and hikes up prices, even if temporarily. And the last one is probably the sabotage of the Nord Stream 1 and 2 pipelines that obviously has created quite a lot of stir, and we do see quite a lot of uncertainty rising about supply to Europe based on concerns about further attacks on European infrastructure. So we see this, but what you also have seen that the prices in Europe have really gone really high higher up than the prices in Asia, which has usually been the opposite. So. But this is not something that came up just at the time. It's been really vulnerability that's been decades in the making. Europe has, in particularly Western Europe, has put all its bet on Russian gas, and it has not provided an backup that could start kind of providing gas from other sources if for any reason Russian gas stopped flowing or would decrease flows. We have seen in a buildup of some of the infrastructure, but it's mostly in Central Eastern Europe, and that's where countries kind of really kept being concerned about Russian willingness and ability to deploy energy as a weapon. And we've seen natural LNG terminals coming up in Poland, Lithuania, and most recently Kirk in Croatia, as well as building different types of interconnectors that would connect these countries. So we have to remember that while Western Europe is very well interconnected with pipelines, this hasn't been the case for Central Eastern Europe. You've seen just only the kind of parallel pipelines going up. Still, so even though there has been LNG kind of build up of infrastructure, it hasn't been enough, and in particular, it hasn't been enough in Western Europe and in Germany, which truly kind of pushed the envelope and really bet on Russian gas, even despite 2014 Russian aggression on Ukraine. So kind of going back to storage, because that's the big part of what currently countries are paying attention to in Europe. Europe really wanted this time around to have its storage full. They have kind of learned a lesson last winter that it's not a good thing. Especially if the supply is not given, or if it's uncertain. Currently, the storage is very high levels. Some countries 100%, most of the countries beyond 80%. And however, this did not come at zero cost. It came at a cost of cutting down demand in industry, and that's the big story, I think, of this winter and the year coming forward. It's not only about the inability to heat houses, which is obviously something that Europe wants to prevent, but it's about the ability of Europe to recover going forward from the industrial downturn that cutting supply of gas to industry has cost. Economic uncertainty is very high levels right now, and probably is going to grow given the high inflation levels and the uncertainty about energy supply, and consumer confidence, of course, much lower than it has been, and that also includes the U.S. So in terms of what Europe could do going forward, part of it is opening more infrastructure and supply, opening it up to supply, so to more supply, and that's the big ones are LNG terminals in Germany that are being currently pursued. 5 of them are supposed to be situated, then 3 of them end of this year, beginning of next year. The one that is not being actually pursued, and that's because France is against it, is a pipeline that could connect the Iberian Peninsula with the rest of Europe, particularly through via France to Germany. And because at that moment, the huge LNG capacity that the Iberian Peninsula actually has is unable to reach the rest of Europe via pipeline. There's very little connection to France. That would make a big difference. So what are the EU tools now to manage gas supply and demand? In terms of EU-wide tools, we have seen that countries agreed on voluntary reduction, and voluntary is the key because it could be problematic going forward. The storage, I've mentioned, countries agreed to fill up storage at least by 80% by November and 90% by November of 2023. Sorry, there is it's not obviously, there's obviously a typo in the year there. That's a big ask year on year. And that's why I will kind of come back to the next year soon. Repower EU is also another kind of proposed regulation that's supposed to implement European climate law in a way to decrease its European reliance on Russia. Some of the things that includes its efficiency goals are increasing and renewable targets are increasing. Country specific, we've seen coal revival. Storage is actually full, even at the higher levels that the EU-wide kind of stipulation sets up. Nuclear power and FSRUs, so the floating storage and regasification units, approximately 25 are now leased and heading for European countries as we speak. But then there is also managing prices issue, right, with cutting supply. EU-wide measures is, and probably we will talk about it, the price cap or concerted negotiations have been suggested. Countries are either cutting taxes to help the customers or imposing taxes to take out some of the windfall that energy industry in other than gas areas was able to make, subsidies to households, regulated tariffs, nationalization of companies. Why I mentioned why the winter of 2023-2024 is problematic is because when you look at this here, that red line on 2022, this was the Russian supply that most likely Europe was not going to get in 2023. So this is going to be that much of more gas that Europe will need to have to fill up its storage throughout the summer, and that might be challenging. We've seen that prices have redirected a lot of LNG to Europe now. A question is, of course, would the price cap change that going forward if that's agreed upon? And U.S. is a big supplier of European natural gas. Now, the big part of that is that it's really not the U.S. producers or U.S. LNG producers that supply it. It's the companies that buy that gas from U.S. producers, and it usually goes where the price is highest. For now, U.S. supply is actually doing relatively well. Storage levels are low, but they are increasing at a very high rate. Monthly production of gas has increased significantly. And also Canada has kind of been pushing for more exports to the US. So that's a good outlook, although we have to remember that both Europe and US are constrained by infrastructure. Thank you.
All right, thank you very much, Anna. Lots to digest there. So our final presentation and panelist is Jason Elliott from the IEA. Now, most of us, when when the IEA comes across our news thread, it's about the fabulous market analytics and data that the IEA gathers. But the original founding function of the IEA is Jason's job, and that's what he's going to tell us about today. So, Jason, over to you. Thank you. I think you may be on mute.
Unmute. Thank you very much.
There
we go. I'm now sharing. I hope you can see my screen now. Thank you very much for the previous speakers, and Louise and Anna gave very good context for me to start talking about the IEA's emergency response system. And I want to take you into it in a little bit more detail and hopefully a very brief presentation on it from a broad perspective, and then happy to go into more detailed discussions of it. The IEA, as was just mentioned, the origins or the reason for the creation of the IEA was really in the emergency response to the oil crisis in the 1970s, and a real attempt at the time to create a system that avoids the competition for limited supplies among the consumer countries, to avoid the go-it-alone kind of uncoordinated policies, recognizing that the most effective response on an international scale is when countries are working in the same direction and not competing with one another. So it was started in Paris through the push of Henry Kissinger at the time to create an effective safety net to the oil system, and creating what was at the time called a sharing system. And this effectively created emergency stocks that weren't in existence at the time, and also among member countries, emergency response to reduce demand quickly in a crisis. So each IEA member country, today we have 31 member countries, each country has a series of responsibilities with respect specifically to oil supply security. And this includes creating an emergency response team that can interface with the domestic oil industry and the emergency system in Paris that we coordinate. And this is linked to appropriate emergency response measures that can be activated in a collective way. A significant part of this is a data collection process. So we have extensive data and information that allows for the assessments and the very nice policy reviews and analysis that people have come to know from the IEA. The origin is very deeply rooted in the data collection system that was put in place for energy supply security and specific oil supply security. And of course, countries then have to have the legal basis for meeting all of these requirements under the treaty that they sign as members of the IEA. So the IEA's oil response system is heavily based on stocks, which is the headline that most people think of when they look at our system. They talk about the 90 days, but we have the possibility within the emergency response to have both supply side and demand side measures. On the supply side, that would include the add in of stocks to using stocks to add to the supply, but also could be increasing production, taking steps in the short term to bring added supply in a very short period of time. And then on the demand side, reducing demand through light or medium or even heavy-handed measures to stop oil consumption in a short-term, temporary period, also to switch out of fuel into other fuels. But in order to create this system and ensure that countries have that, we have within the obligations the requirement to hold emergency oil stocks, and each country also must have a system in place to be able to reduce oil demand very quickly by up to 10%. So for the oil stockholding obligation, the 90 days of net imports, in fact, is not emergency stocks. It is a stockholding requirement that requires that all stocks in the country overall are at least 90 days of net imports at any given time. What this means is that countries have to create a system given their national circumstances in order to be holding emergency stocks that ensure this level is met at all times, and the ability to respond to a crisis. And so there's different models that countries have. You can see that in the diagram with the circles. The government stockholding methods, such as what you see in the United States. We have the strategic reserves in oil stocks in salt domes held specifically by the government in case of a disruption, like in the U.S. SPR. But you also have specialized agencies in countries you see on the right circle, like Germany or Belgium, that have set up stockholding entities where they're specialized in holding stocks expressly for the need in case of a disruption. And then some countries, they place an obligation on industry to hold stocks in case of need. And you have a number of countries that have a mixed system that includes both government stocks or agency stocks on top of an industry obligation. And that the result of that means that you have varied systems across IEA countries, so that when we do have a collective action and release, the systems are quite different and depend on how each country's national system is created to do that. Within that, there's a great flexibility, as you can see, in choosing the model to meet the obligation, but also what stocks are being held for that obligation. So that can be crude oil, like we see in the U.S. SPR, but it could be products or a mixture of the two. And that, of course, is going to depend on each country, whether they have a large refining sector, or if they have no refining at all, then they'll tend to hold refined products. In Europe, we see much more refined products because in addition to the IEA stockholding obligation, European countries have a requirement as members of the EU to hold refined products, a minimum level of refined products as well within their emergency stocks. So this image gives you an idea of how the stocks are distributed across the IEA member countries in the 3 different regions. I've chosen to show you an image of the stock level, both commercial and strategic stocks, in February of this year. That was just before we had our collective action starting in March following Russia's invasion of Ukraine. You can see the distribution heavily in, for example, the North American strategic stocks held publicly or in crude, whereas in Europe, you can see there's public stocks of both crude and product, and we see more crude being held in Asia. And in the stockholding in industry in Europe, a large amount of those stocks are being held under requirements of the governments for those industry operators to hold minimum stockholding requirements. And so in the total stocks that were being held in February, 4.1 billion barrels across commercial and emergency reserves, about 1.4, almost 1.5 billion barrels were being held publicly just in case of an emergency, with an additional 500 million barrels or 580 million barrels being held by industry to meet national obligations. So then to talk about the IEA's collective actions and how this works, this begins with a continuous assessment of the oil market. We have extensive data and expert analysis on what's happening on the oil market at all times. We come out with our monthly oil market report, which is looking at normal market trends and outlook for the coming 2-3 years. And of course, we have longer term outlooks in our analysis across the agency more broadly. But in the ongoing continuous assessment, this means that if there is a disruption, we have the ability to analyze this disruption, to see the size of the disruption in the context of the current supply-demand balance, and whether an IEA collective action is necessary, and then also to analyze that that action on the market as it's being implemented. We've set up a rapid decision-making framework among 31 member countries. As you can imagine, it's difficult to come to a quick decision in a short period of time, but we have a framework that allows us to make decisions within a 24 to 48 hour period. This does require unanimous decisions to activate our collective actions. And the way the initial plan for releasing emergency stocks is done is that each country is asked to contribute a share according to their oil consumption. So as you can see in this graph on the right, the United States represents about 42% of total oil consumption across the IEA member countries. That means when we come together for a collective action, the United States would be expected to contribute at least 42% of that action. This works out at about 1/3 of the total action coming from European countries, nearly or a little over a half coming from the North American countries, and the remainder coming from our 4 countries in Asia. As I mentioned, the high diverse systems across countries means that there's a lot of flexibility in the actual way that the oil is being released and the different mechanisms. In the countries that have public stocks, they would tender those stocks onto the market and letting markets take it up, but whether it's being purchases or loans. In cases where obligations on industry are used, those can be lowered, which frees up volumes for industry that they normally wouldn't be able to use. They suddenly become free for their use. But in any case, it's the market that decides how to absorb or how to use the volumes that are released in the market at the time of the collective action. So it's not pushed onto the market, but it's made available as the market needs and over the time that it needs this. And within the system, we have practice communication strategy, which includes dialogue across all member countries to make sure that our communications are in line, and we outreach with our association countries to have their participation to the extent possible. So when it comes to—
Jason, can I just interrupt for one question? When you say association countries, do you mean China and India?
Yes, so we have a series of agreements with association countries and IEA, more formal agreements, and that does include China and India and a number of other countries as well, in Asian countries, also in South America.
Thank you.
So when it comes to past disruptions and IEA stock releases, this graph shows you a number of major supply disruptions that we've had in the global markets in time since the IEA was created, not well before. You can see from this since 1970, the IEA has not acted in every disruption, and even in the 3 times prior to 2022, when the IEA had taken actions in 91, 2005, and 2011, those in themselves were not the largest of disruptions in record. In fact, it shows that it will depend on the disruption and the market context in which it takes place, and whether the normal market functions, whether industry and commercial stocks are able to absorb the disruption, what happens to alternative supplies that come to the market. So those are all the kind of factors that go into determining when a disruption is happening, whether there's a need for the IEA collective reaction. And as I think everyone is well aware now that the IEA has taken collective action this year, we've had 2 releases following the Russian invasion of Ukraine, starting first in March, where countries agreed to release a total of 62.7 million barrels. And then again, the following month, when countries agreed to release an additional 120 million barrels. At the same time, countries can release or take more independent actions to release strategic stocks. That's been the case for the U.S., whose commitment in April was to offer up to 1 million barrels a day of oil stocks from the period through to October. And this pledge of 1 million barrels a day included the volumes that were committed as part of the IEA collective action. So what it means is a lot more than what the IEA had brought through the collective action. A lot more was being released from public stocks. So a total of 240 million barrels is being or will have been released through November, from the March through the November period, including all releases across the IEA member countries. And even with this largest release, it's clearly and most definitely the largest release in the history of the IEA. Even with this, we have public stocks that remain a very significant security buffer for the future and into the coming winter, and as we look at what's going to happen in the months to come. After this release, remains 1.2 billion barrels of public stocks held across all IEA countries. That includes 446 million barrels of publicly held stocks in IEA Europe, which this graphic is showing how those are broken out among crude oil and refined products. And in addition to that, as I mentioned in the previous slide, there's an obligation set on industry to maintain a little over 550 million barrels of stocks in order to reach national obligations, which can be lowered to make additional oil available to the market. Oil stocks are a very important part, and in fact, a very significant focus of the IEA's emergency response system. But as I mentioned as well, we have across the member countries policies that are able to be activated to reduce demand in a short-term way. But we see that the demand side of the equation, particularly in the current context, is a very important part of how we think we need to deal with the current energy crisis that we're facing today. Already early in March, the IEA came out with a 10-point plan on how countries could cut oil use. A large part of this is focused on the policies that are in place in member countries in order to meet their IEA requirement for demand, the 10% demand restraint that they must be able to reach. But it goes beyond that as well. It's taking measures in the short term to adopt, for example, a more efficient vehicle, a fleet, or promoting more efficient use of shipping that can be more long-term in nature to be saving, reducing oil consumption, saving oil in the period that we're entering into where supplies are very tight. We estimate that if all IEA member countries were to implement these measures that we've listed out, around 2.7 million barrels a day could be saved through such actions. Of course, as was mentioned by Anna about the gas markets, this is also a very important aspect where demand side measures can play a part. The IEA already early in March, on the 3rd of March, came out with a 10-point plan for European countries and how they could reduce their reliance on Russian natural gas imports with a series of actions that could be taken. This was launched together with the EU Commission and the French EU presidency, coming up with a series of measures which could be implemented within a year in order to reduce the need for Russian gas imports by about 1/3 within that period of time. The IEA has also, in April, launched an awareness campaign calling Playing My Part, which goes to more the households of what can the average consumer do in order to reduce their use of gas, not only to save money and reduce the reliance on Russian energy in support of Ukraine, but also in line with helping the planet in energy use. I'll stop there, and I look forward to having a discussion with everyone. Thank you.
Thank you very much, Jason. And we'll now open up a brief discussion with the panelists and turn to your questions, a number of which have already come in, and a number of which are on themes that kind of span all three of the the presentations. And this is notwithstanding the relatively sanguine base case presentation that Anna-Louise had for the oil side. A lot of the questions have been around what are the policy responses that we could see, if things get worse, both across oil and natural gas. Anna, there were questions around, what are the efficacy of the demand restraint measures? Jason, you mentioned kind of fuel switching on the oil side, but of course, with natural gas prices being so high, scope for that looks to be limited. I perceive a real reluctance among policymakers, both in the United States and in Europe, to engage in kind of, the kind of public advocacy campaigns to conserve energy. And my personal optic is that politicians here in the U.S. are haunted by the image of Jimmy Carter in a cardigan sweater and a one-term presidency. But again, that's my personal bias, and I would love to hear all three of the panelists kind of bring their expertise to bear on this question of, if things do get worse, what are the policy levers that are available and likely to be employed? And Louise, why don't we just start with you, and we'll go kind of in the order where we had the presentations.
Okay, well, I'm going to stomp on Jason's ground a little bit here, because I'll speak about U.S. and Europe. They've already implemented a lot of policy against Russia's exports, but sort of goes in the opposite direction of cutting supply. And they're not getting a lot of cooperation with OPEC Plus agreeing today on the 1.8 million barrel day cut. Actual cut, it sounds like, of 900,000 barrels a day to 1 million. So the market could be tighter next year, but we do have, for oil at least, recession and just COVID and the lockdowns in China and this sort of thing forming significant downside risk to demand, which could, regardless of policy, which could actually help eke through. But to get to Jason's point, which was very helpful in terms of what can the IEA do, the U.S. has already been cooperating with the IEA. It's released a lot of oil from its SPR. It's gone from over 500 to 400. It's released over 120 million barrels and planning to through the end of this year. So my point is that other than the demand side that Jason explained, the U.S. could be to a degree limited by further SPR drawdowns. It could still do it. Of course, there's 400 million, but there's going to be somewhat of a limit there on how much they can withdraw in terms of putting its own stockpile at risk. So we'll have to see how bad it gets. I doubt President Biden would be able to do this just to make prices go down. It's going to have to be more of a supply shortage to do further withdrawals. And I don't think they're going to start to rebuild stocks right away during the winter. That probably isn't a very good idea. So that would be my quick comments, Mark.
All right. Anna.
So it will be probably more difficult with natural gas, and there's many kind of effects that can happen, and many policies that will be introduced will be pulled from different directions, because we have that especially over the winter, gas is a heating fuel, so we will more likely than not see a decrease in gas demand, although that demand has been pulled by the requirement of and push for filling stock supply. So that's something to kind of to think of when we're thinking about how much more can the demand grow. That being said, again, there's gonna be pull from different directions. There's gonna be pull out, how can we decrease the demand? So what can we do? And probably the best way would be to appeal to people, and you could do this, although we have already seen that the appeals, at least for now, have not really worked out very well in Europe. We have not seen the decrease in demand when the cold weather hit last week that one would actually hope for. So this is something to be considered. It's mostly that the prices are gonna kind of keep people away from thermostats and cranking them up a little bit more. That being said, prices are a problem for government as well, because especially those governments that are up for re-election, and there are some of those, and that's where governments are going to be looking at, well, how can we make it more manageable for people? And of course, this is kind of the issue of how, if we make it more manageable for people, they're going to use more gas. Can there be specific restrictions? It's going to be very difficult to balance it. And we will see kind of probably going back and forth between different policies, and different countries will have different policies. That's also the case. If it's very cold, we will see probably there's going to be a try to the European solidarity and ability for Europe to manage its demand as a whole.
Okay. All right. Thank you. And for Jason?
Yeah, just briefly, because I see we have questions. I don't know if you want to go into more specific some of the questions, but absolutely, demand restraints, I think, is the most, the consumers are most open to hearing the methods are being willing to accept government policies towards demand restraint during such times as crisis, when they see absolutely the disrupted markets and the need for that. And so we think there's a lot of room for public appeals for reducing demand, implementing things. So potentially the real opportunity is during such times. Of course, the IEA's system is focused on bringing additional supply in order to avoid the kind of hurt that comes with the disruption. Yeah, exactly.
Just an example of the kind of public campaigns from what we saw in World War II. I'll stop.
Yeah, I know, and absolutely. I think that's when demand restraint is maybe more politically acceptable. I mean, when you see, for example, a disruption like we've seen in past, like the Hurricane Katrina, calling on countries to reduce demand because of refinery and platform outages in the Gulf of Mexico, doesn't really appeal to many, but governments' use of stocks can help absorb the negative impact of that disruption to their economies. But in what we're seeing now, stocks can't take care of the energy crisis we're going into. It takes more.
All right. So let me follow up on that. Anna, you mentioned the risk of price controls on the gas side. How about more? Again, and these a number of questions have come in. Already kind of probing further on. How about more extreme policies like outright bans on exports? There's just yesterday here in the United States, a couple of trade groups wrote to the Secretary of Energy saying, hey, we're hearing some buzz about potential to ban exports of refined products and trying to argue why that was a bad idea. I mean, Anne Louise, I'd be interested in your reaction to that and to the degree other panelists want to weigh in as well.
In terms of trying to do a price cap as well as the EU ban on
and
Russian
an outright
oil.
ban on export of refined products.
Yeah, exactly. Oh, the U.S. one. Oh, yeah, no, that's, I can't, I mean, that would really be going against the IEA's mandate. I mean, I would be very, very surprised if the U.S. were to actually agree to that. I mean, the pressure to agree to that is weakened with the decline in gasoline prices, which is, of course, the measure that everyone's looking at. But if they did do that, then obviously that would have an extreme effect on the distillate market going into the winter. And it would actually defeat the purpose of what the U.S. is trying to do, which is to keep Europe and the alliance, so to speak, supporting Ukraine together. So I would be very surprised if they actually did that, because it would drive up prices of distillate at the very time we're heading in the winter. That would be very negative effect.
Okay. Just very quickly, just looking for a very quick answer on the following. So first for Jason, has the IEA studied what is the maximum withdrawal capacity, within its strategic stockpile system? I know the U.S. Energy Department says it can release a maximum of about 4.4 million barrels a day temporarily, anyway. But for the IEA countries as a whole, what's the view?
So that the question of maximum draw, I think, is a tricky one to maybe take with caution. The 4.4 figure that you referenced for the US SPR, together with IEA's estimates for other IEA countries, takes us to about 14 million barrels a day of total technical maximum draw. The thing about a maximum draw, though, is, and for example, for that US 4.4, that's based on the perfect conditions for drawing out oil, maximum pump, able to get it into those pipes and have a place for it to go, get it in the tanks. That's not the conditions we reach in the real world. And we've seen from the US, the SPR, they released or they offered to release up to 1 million barrels a day. It doesn't come out like a flow like that. It comes out in a little bit of more batches and sticky ways. They were not ever able to, in the months that we've seen in the past 6 months, to get truly 1 million barrels a day. They got close in June, again, close here in September, but there were more like about 800 to 900,000 barrels a day on average of that flow. I think that's roughly probably close to reality of about 1 million barrels a day of their maximum capacity.
Interesting. Thank you. And Louise, what's Wood Mackenzie's view on spare production capacity in the world right now? And just very quickly, how quickly could U.S. producers ramp up, in the right circumstances?
Okay, two very germane questions. On the spare productive capacity, clearly there's spare capacity in producers like Russia. But that's inaccessible because of the impact of sanctions. But if we turn to where we think it rests, it's within OPEC. It's within three key producers in OPEC: Saudi Arabia, UAE, and Kuwait. If you add them together, within 30 days, roughly, we estimate that about 2 million barrels a day max could come into the market. The more Saudi cuts, the more spare capacity there will be. But let's just put it at around 2 million. Now, beyond that month window, which is, a good definition for immediate availability of 2 million, if you look at, let's say, 90 days, and where money is spent, logistic action is taken, pipelines are adjusted, then perhaps potentially another 500,000 barrels a day could come into the market. So we're talking roughly 2.5, but for the immediate window, 2. Now, on the second question, on U.S. producers in the lower 48, which is where you have the most variability because of their short drilling time, we estimate that really the producers, the main players in the lower 48 in terms of amount of production that they create, are the independents. The majors are growing production. The private operators are growing production, but the independents are under a lot of pressure from their investors to take a very restrained attitude towards growing production. It's a very different reaction to these high prices we've seen this year.
Right.
So in order to trigger a short-term surge in U.S. production, it's going to be extremely difficult. Prices are going to have to be on a sustained basis. Basically, we estimate within $70 to $100 a barrel. That's kind of agnostic for independent producers. So on a sustained basis, prices would need to be above $100 a barrel in order to bring more production to the market. But there's all kinds of logistical constraints, availability of rigs and workers and that sort of thing. So I wouldn't count on the U.S. creating surges in output. Good growth next year, 600,000 barrels a day from the lower 48, some from the Gulf of Mexico, but I wouldn't count on it as being a source of spare capacity right now.
Okay. No, I think that's all very fair, and raises the point of the investors that we've talked about
Yes.
in separate panels.
Yeah.
Previously. Anna, last question for you. We've run a bit past the top of the hour, but there have been so many great questions coming in that I was hoping that I could take advantage of everyone's time for an extra 10 minutes. So Anna, last one will be for you. Any relief coming on LNG capacity? Are we going to see any big growth in new LNG supplies and the supply availability next year?
No, not really. Actually, we probably need to wait for 2024 to grow some capacity, and that will be mostly actually in the U.S. There is, I think, nowhere else in 2024 where LNG capacity will grow but the U.S. And it's gonna be 22, I think, to 25 million tons per annum. So it's quite significant. Mid-decade, we'll see a little bit more growth, including Qatar. But really, the most immediate is the U.S. Additions that will go forward.
Yeah, so no quick fixes for oil or gas supply. Well, let me give each of you, if you want it, if you want to take a minute to just offer any final comments on excuse me, kind of things that tie these threads together, or things that we've missed that you think are important to get into the room. I want to make sure I give you each a chance to, offer any final comments if you have them. And we'll just go again in the same order that we did with the speaking. So with Anne-Louise.
Sure. I'm going to just quickly answer a question very quickly. No, I did not mean the U.S. is on purpose restricting Russia's production or exports. I meant that indirectly sanctions limit to a degree production and exports because it restrains the ability of Russia to move its crude to other countries. Really overall, though, for the oil market, it's got one advantage over gas, which is that it can raise production relatively quickly. We've got a little bit of spare capacity. It's not a lot. And that on that regard, it does have some flexibility as we move into this next year of major uncertainty.
Thank you. Anna, any brief thoughts of things that we've missed on your end?
Well, not maybe missed, but kind of underscored that infrastructure is a key actually for natural gas. It's something that takes time to develop. It's very expensive. And that's what will be needed for the flows of natural gas around the globe to become more sustainable on both sides, supply and demand. So it's not only the export terminals, it's also the import terminals. And in many ways, this crisscrosses the issue of decarbonization in places like in Europe, which has, especially before the invasion, committed itself to decarbonization, hasn't really been into getting more LNG terminals because it was seen as grandfathering in the fossil fuels that Europe wanted to get rid of. Well, we will see this kind of now different trends within after the invasion, because we do see actually recovery of coal, and that's needed for generation in order to replace natural gas that goes into storage or later for heating. But also we see kind of the push for more renewables. It's kind of these two divergent paths that occurred at the same time, both of which are somewhat problematic for natural gas and its development. So because you, again, especially for export infrastructure, it's a lot of money that needs to be put in, that you need to have contracts and so on. And we have seen reluctance, now less so, from the European buyers in particular to commit.
Yep, and I'll flag for the folks who are online that Anna and I actually wrote a paper just last month comparing and contrasting U.S. and European approaches to kind of linking the current crisis to the longer-term energy transformation, agenda. Jason, anything we missed on your end?
I just want to address just a couple of questions real quick that I see online. Russia is not a part of the IEA. We are 31 member countries of OECD countries. Does not include Russia. All countries have a voice in how we take collective action. So any one country saying no, so it's not just voted based on weight. The IEA is based on oil consumption to contribute your share. So the US's share is based on that. The US release of strategic stocks is well in line with the IEA's collective action. US is releasing about a total of 165 million barrels linked to the IEA's action, but not all part of that total. And that's what countries hold the emergency stocks for, is dealing with their determined need of releasing in the time of a crisis. But we think demand is a very important aspect going forward. We're working hard still, as we have in the past, and still continuing with the European Commission, but all of our member countries, on how to improve demand reduction efforts going forward, not only for oil, but also natural gas. And hopefully you'll be seeing more of that in the months to come.
Great. Okay. Well, and thank you again to all of you. What we've done is review kind of the underlying supply and demand fundamentals in the marketplace, as well as the risks to supply and the kind of emergency coping mechanisms. If you were signing on today hoping for a price forecast, I'm afraid that we may have disappointed you, although Anne-Louise did show hers. But really, to me, it's not about trying to predict the unpredictable, but hopefully we've left you all with a better sense of the issues facing U.S. and global energy markets as the days get shorter here in the Northern Hemisphere. Winter is coming, but we can take comfort in the knowledge that it won't last forever. Energy markets, like the seasons, are cyclical. We began with a reference to Game of Thrones. Let me end by quoting Samuel Taylor Coleridge via Bill Murray in the movie Groundhog Day. Winter, slumbering in the open air, wears on his smiling face a dream of spring. Please join me in thanking Anne-Louise, Anna, and Jason, as well as the top-notch events team here at the Baker Institute. Serena and Andrew, thank you all. Some of the slides and a replay of the event will be available after the fact on our website, because we've gotten questions on that. And most importantly, thanks to each of you. Thanks for taking time out of your day to join us for the conversation today. Thank you for your questions and engagement. We hope you found this to be a helpful addition to the discussion of energy issues. We look forward to seeing you at our next event, online or hopefully even better, in person. Thank you all.